You've probably seen the headlines that the Federal Reserve have cut rates this year, and many expect a couple more cuts to come. Inflation has dropped down to about 3, and so you would think that mortgage rates would follow, right? But they haven't. They're still sitting above 6%, and today let's talk about why. The Fed controls what's called the federal funds rate, and that is basically the interest rate that banks charge each other for overnight loans. So when that rate goes down, when the feds make their announcement, it makes short-term borrowing cheaper. Things like credit cards, car loans, business lines of credit, those things respond quickly. But mortgage rates, they don't work that way. And here's why. A mortgage is a long-term loan, 15, 30 years, and so lenders aren't focused on what happens overnight. They're watching the 10-year Treasury Bond. That's essentially the benchmark for where investors believe the economy is headed over the next decade. So right now, the 10-year Treasury sits around 4, but mortgage rates are still over 6%. So that difference between the two is called the spread. So think of the spread like your local grocery store, right? A farmer might sell milk for $1 a gallon wholesale, but by the time it hits your fridge, it's $3 or $4 or more. That markup covers trucking, refrigeration, labor, packaging, and yes, profit. Lenders are essentially doing the same thing. They start with a base rate, like the Treasury yield, and then they have their own costs and risk, and then they buffer that before it reaches you as a mortgage rate. So for over 50 years, that spread that we look at has averaged 1.76%. It's always been a symbiotic relationship. But right now, however, that spread's closer to 2.3. It was even higher in the last 18 months or so, and so the spread is coming down, but still, that's significantly higher than the 50-year average. That's part of what's keeping rates high. So what's behind this bigger markup? I think it's 3 main things. First, inflation hasn't cooled everywhere. Rents are still rising, insurance costs have skyrocketed, and services like childcare and healthcare are still outpacing wages. So lenders see that and they think inflation could flare up again, so they price in a little extra protection. Second, the Fed stepped out of the mortgage market. So during the pandemic, they were buying up mortgage-backed securities, which kept rates lower. But now, private investors set the price, and they expect higher returns for that risk. And third, it's uncertainty. Between global tensions, high government debt, and a choppy housing market, investors are just nervous. And nervous investors demand bigger markups. So where does that leave us? Rates are probably not going to move dramatically until 3 things happen. First, inflation levels off for good. Second, the Fed gives us some clear support in the mortgage market. And third, investors start feeling confident again. Even optimistic economists and forecasts only see mortgage rates dipping below 6% late into 2026. But let's put some perspective for today's average, right? The 30-year rate is right around 6.2, and that feels high compared to the 3% that we saw during COVID. But historically, that 50-year average is about 7.5%. And back in the early 80s, things were over 18. So what do you do if you want to buy a home? The lesson isn't to wait for rates to return to 3%. Listen, that's not the world we live in anymore. The lesson is to make a smart decision in the market we have. So if you're buying, adjust your budget. Maybe explore some new neighborhoods. Maybe look at creative things to buy down the rate. If you're refinancing, wait for a smaller dip instead of just holding out for the bottom. I mean, at the end of the day, the market you're in is the market you've got. So make a smart move within it.